welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Some of the stories now we're tracking in the BNN Bloomberg newsroom. GM Canada is investing an additional $63 million in its Oshawa assembly plant. The move is for its next generation full-size truck production and will upgrade operations and enhance its service parts business. This brings GM's total investment in Oshawa to $1.5 billion. The Oshawa plant currently builds Chevrolet Silverado light and heavy-duty full-size pickups and is GM's only North American facility producing both models on the same line. Shares of Northern Dynasty are plunging today. They're off more than 36% after the U.S. Justice Department said it's upholding a previously imposed veto on mining at the company's Pebble deposit in Alaska. The Vancouver-based miner says it prefers a settlement that withdraws the veto, but will continue to pursue the case. Northern Dynasty says the decision could be used as a precedent to stop future U.S. resource projects. Shares of RB Global are moving higher today after the company reported profit and revenue in its latest quarter that topped estimates. RB also saw an increase in inventory sales and service revenue compared to the year before. The company says the results were driven by financial discipline and continued investment in strategic initiatives. And taking a look at the markets, nice bounce back happening today for the TSX after that loss yesterday. It's up, pushing into record territory again around there. It's up 1.29% right now south of the border. AI fears again easing, so you can see the response to that. The S&P 500 up by 0.86, Dow by about 0.6, and the NASDAQ is up by 1.33 now. As the rotation away from software and tech continues, other segments of the market are starting to gain momentum, with energy and materials seeing an inflow of new investments. For more on this, we're joined by Teresa Schutt, Chief Investment Officer at Harbourfront Wealth Management. Teresa, thanks as always for joining us.
Thanks as always for having me. Hi, Roger.
Hi. Quite a day. It's a bounce back for the NASDAQ.
Indeed.
It's up by 1.33. Are people having second thoughts, or are we still seeing that rotation?
I think we're still seeing that rotation. I mean, certainly U.S. stocks have been rocked this month by these concerns over AI CapEx and whatnot. Obviously, we've got the FOMC minute release later today that will give some insight into maybe the outlook going forward, under Warsh's leadership. I think people are looking to that for some sort of signaling. But I do think, there is kind of a decisive shift in leadership underway in terms of the market. So, investors are obviously moving away from some tech names, in particular software, and traditional S&P segments, industrials, financials, energy, and materials are gaining, fairly strong momentum still. And I think it's really, kind of the fact that these traditional companies still provide this sort of haven of earnings reliability. They're largely insulated from some of the AI-driven margin compression. And in fact, I think that, they're really well positioned to benefit from these shifting dynamics. And so what we're seeing, I think, is investor preferences being recalibrated. According to the Investment Manager Index, industrials, energy, basic materials have climbed to the top of the sector rankings, with industrials climbing to the #1 spot and the first time in 6 years. And I like to talk about Caterpillar. It's a prime example of an industrial name that's returning to favor, and not just because of its traditional model. It's in fact, I think, a standout because it's really a prime beneficiary of AI-driven infrastructure growth. So while we talk about CapEx spend and whatnot, is it too much? Is it too little? This company in particular, their construction equipment is essential for building new data centers, while the power and energy division is thriving by supplying turbines and these large reciprocating engines that meet the redundancy needs of these facilities. So their shares over the past past month, in fact, have risen almost 20%. And so I think there's really some interesting dynamics going on in the market. And I think, markets need to focus less on, pricing AI potential and pricing AI economics. And some of these companies that are benefiting from AI, as well as providing that, kind of stability in earnings, and the fact that the U.S. administration is investing in the industrial sector, in the defense sector, I think this rotation is going to continue.
All right. And with the AI economics, are you talking about companies that like Caterpillar or companies that are starting to incorporate it?
Yeah, both. I think, now we're finally starting to talk about the winners and the losers, I think. There was a point where really the AI narrative was this all-encompassing force, and that drove all markets higher. Now we're seeing this selectivity emerge, and we're seeing that, some earnings reactions like, Cisco, Shopify, maybe, investors are less impressed. I mean, good growth isn't enough, frankly. So we're starting to see the market kind of sort the AI trade. And I think you're seeing winners, which is the, compute, semiconductors, AI infrastructure, I think what we're calling picks and shovels, that is hardware over software. And I think for these players, AI demand is visible, it's contractual, it's front-loaded, and the revenues are tied to the capacity build out, not end user monetization. And I think that's really important. And we're also seeing the enablers do well. So this is power, natural gas, players such as this, which I think is also really interesting. Now on the loser side, obviously, we're seeing, software obviously come under pressure. And that's really because, the AI disruption and some of these applications will undermine their moats. And so people are starting to question kind of these long-terminal multiples, not so much near-term growth. I mean, obviously, some of the software is essential for critical mission uses at large organizations. They're not going away anytime soon. But I do think that there is kind of a shift away from this idea of like everything that's AI is great to, maybe we need to really think about who's going to benefit and who's not, and, who's adopting it quicker and in the most intelligent way. I think there's going to be a risk of kind of AI washing, much as we saw with the ESG theme, which was the greenwashing that we saw. So, we have to be really clear about, which companies are actually using it, and how it's affecting their productivity, innovation, and their margins.
All right. And just going back, a couple of things I just wanted to bring in there about the earnings. They had is it being unrealistic? Is the market being unrealistic with the reaction to some of the earnings that we're seeing? Are they going to have to eventually say, you know what, these are really good earnings and the companies are good?
Yeah, I think so. I think, what's interesting is we're seeing, more micro and earnings really dominating the headlines. And there seems to be this kind of shrugging off of some of the macro data that we're seeing, whether that's jobs, inflation. People just are really focused on how well and profitable these companies are doing without kind of thinking about the longer term. And I think that's starting to shift. I mean, really right now, I think stock selection is really critical. I think this is a great time for stock selection. I think you saw, Berkshire Hathaway had made some interesting choices. They've continued to trim Apple. They sold Amazon. They're buying the New York Times. So I think we're seeing, this kind of at work where, people are starting to look beyond just these earnings and the fact that, they continue to beat expectations, and more announcements from NVIDIA about partnerships with Mega and elsewhere. I think people are starting to really step back, be more pragmatic, and really understand, where those earnings are coming from and how sustainable they are.
All right, we'll have to leave it there. But Teresa, thank you as always for joining us.
Thanks, Roger. Thanks for having me.
Teresa Schutt is Chief Investment Officer at Harbourfront Wealth Management. Shares of the trucking company TFI International are falling after the Quebec-based company saw a drop in fourth quarter revenue. We'll break it down after this. Shares of TFI International are under pressure, albeit they're bouncing back a little bit, but they're still down about 3.57% after reporting a revenue drop in the fourth quarter as the transportation firm continues to face weak demand. Here to talk more about it is Bruce Chan, Managing Director for Global Transportation at Stifel. Bruce, thanks very much for joining us.
Yeah, great. Thanks, Roger. Appreciate you having me.
A mixed report. I mean, looking back, not so bad. Looking forward, people not so happy about it.
Yeah, I think that's right. Our view is that performance in the fourth quarter actually was quite good. Results came in certainly ahead of our expectations, above the guidance midpoint. So from an operating perspective, I think the company did well. What we think, most of the pressure is on the stock today is from a first quarter guide that's materially below where the street had been pre-print.
And what's the worry about that?
Yeah, I think, right now there are a lot of prevailing concerns about what's going to happen with the demand environment. We've been, of course, in, a freight slump that's lasted about 3.5 years, which compares to, a typical freight cycle, which is maybe 18 months of its entirety. So I think there's some concerns that, some of the green shoots and positive indicators that we're seeing, maybe are not materializing. And I think that's what investors are picking up today.
And does it look, when you say they're not materializing, does it look extended? I mean, are we talking maybe the end of the year turnaround, or is it looking that it might be longer than that?
Our thought is that we actually should be seeing some good inflection in the cycle, based mostly on supply exits in the industry, but again on some building demand opportunity that should be hitting sometime around mid-year, maybe at the earliest in March into the second quarter freight peak. I think, where you're seeing the concern is that, these demand indicators are a flash in the pan, and the regulatory pressure that you're seeing on supply may ultimately not come to fruition.
And what is some of that regulatory pressure? What are some of the concerns?
Yeah, most of them have to do with U.S. Regulations. The Trump administration has made a big push against non-compliant immigrant drivers. So the big one here is the FMCSA's final ruling on non-domiciled truckers, which we anticipate could ultimately take out as much as, call it 15% of the overall for-hire over-the-road trucking market. Right now, we're expecting maybe a 4 to 5% impact this year from just that regulation alone. But you're also seeing a material crackdown on drivers that are not proficient in English language. You're seeing a crackdown on, so-called fly-by-night driving schools, as well as non-compliant electronic logging device operators.
And is there a concern with that, with TFI, Canadian, French-based, issues about the language and other things?
We don't see it as being so much of a concern for TFI. Ultimately, I think this will be a benefit for TFI. They have a more rigorous vetting process than what you see with the mom and pop owner-operator carrier community, which is still the vast majority of supply in this industry. So we think that actually should be a tailwind for TFI. I think, some of the concern really has more to do with whether or not the supply crackdown ultimately materializes. But you bring up a good point with TFI's geographic mix. There is also a lot of concern for how, future talks around USMCA and the trade relationship between the U.S., Canada, and Mexico are going to develop. We have, July 1st as an upcoming kind of deadline for those renegotiations. And I think the sense is that there's some pent-up demand, not just from customers, but if you also think about, acquisition targets, the M&A environment, that is waiting for that issue to settle.
And with CUSMA, what kind of an impact might that have? We've heard talk that it might be individual deals between Canada and the U.S., Canada and Mexico. What kind of an impact might all that have? Has any of that been factored in yet, or is it still just sitting and waiting?
Yeah, I think it's mostly sitting and waiting. It's hard to say what the market has baked so far in terms of that impact. I think at this point, most investors are expecting some sort of status quo. So, any developments there to the upside obviously would be positive for valuations, obviously for the stock. But I think there's still a lot of uncertainty, which, to an extent is being factored into some of the valuations and certainly into the demand front as far as that pent-up demand that I talked about.
All right. And any tailwinds or any potential tailwinds for it?
I think so. I think if we see positive resolution really on any of these, regulatory or trade initiatives, that would unlock a good measure of demand. I think that would be viewed as a favorable development.
And going in a different direction for a sec, any merger and acquisition M&As happening right now? or on the
Most of
horizon?
the outlook for M&A is for a pretty strong year in 2026. Another story of pent-up demand there, probably some of it tied to regulatory uncertainty. You've also had more of a meeting of the minds between buyers and sellers. So I think the outlook is good for M&A. From TFI's perspective, they're still positioning conservatively on the M&A front. They said that investors should expect about 200 to 300 million, but mostly focused on that small tuck-in acquisition, which up to this point has really been the company's core bread and butter. As far as larger deals, they'd probably be looking into 2027 before really considering that.
And would any of those acquisitions or mergers, would they be down in the States or are they up here? Have they alluded or hinted at it at all?
Yeah, I think at this point, our take is that they might be mostly focused on the States. I would see, as far as large scale M&A is concerned, to expect something in the LTL division in the U.S. to add, density to that network. You might also see something on the logistics front, primarily in the U.S. as well.
Okay, we'll wrap it up there, Bruce, but thanks as always for joining us.
All right. Thanks, Roger.
That's Bruce Chan, Managing Director for Global Transportation at Stifel. Coming up, the largest streaming deal in history. Wheaton Precious Metals is doubling down on antimony and silver. We'll bring you our conversation with the company's CEO right after the break. Wheaton Precious Metals is buying a silver stream on BHP's portion of the antimony mine in Peru for $4.3 billion in upfront cash. This is the largest streaming deal in history. Wheaton already has a silver stream on antimony with Glencore. For more on this, we spoke with Randy Smallwood, Chief Executive Officer of Wheaton Precious Metals.
It's been the strongest performing single asset in our portfolio. We've seen 17% more metal than what we expected on the original acquisition. So it is one of the reasons that we're so excited about being able to double down on this one. BHP's share is equal to Glencore's. There's only a slight difference. The payability for BHP's share is 90%, whereas for Glencore it's 100%. But essentially, it is a full double down in terms of silver. So really, becomes our second biggest asset within Wheaton, and quite excited to have such a quality asset at that level.
After the huge Salobo mine in Brazil, the Vale mine. Now, I read, and this is prior to this deal, I think it was a couple of weeks ago, that at current spot prices then, and silver has come off its highs, silver on paper was accounting for about 70% of your revenue. Now, I know that's a moving target, but does that sound plausible? Could silver have got that high as a percent of your total revenue?
No, last year, with the guidance a year ago, silver was about 35% of our revenue.
Okay.
With the updated numbers, we were getting close to 50, and with this add-on, we're probably about 55, 56% of our revenue right now. I guess when silver peaked at $115 here just recently, it might have been a bump higher than that 56%. But
right.
But yeah, your comment on Silver Wheaton at the start of this is we're starting to get a little bit more of a silver shine to us, aren't we?
Yeah, because years ago you started, your basic plan was, you guys, silver doesn't get valued in a company like BHP, so we'll go in and we'll buy the silver, and our paper will get a much higher valuation in the market.
Yeah, we spent the first 10 years in this company looking for silver streams. And so it's only over the last 11 or 12 years that we started focusing on all precious metals, and we've done very well on the gold side. One of the challenges is looking for opportunities in the silver space. And so when something like antimony comes along, and BHP has huge capital needs, they're growing in so many different places and need the capital. You just make sure that you are set up so that you can take advantage of these opportunities. So yeah, it's tough to find good silver production, especially such high margin silver production, and pretty excited to bring this one in.
TD have a buy on your stock, but they do say that the initial deal returns look low on our production assumptions and spot silver. However, of course, the beauty of your model is that as the mine expands, you get more silver. They're calculating a pre-tax internal rate of return of only about 2.1% based on spot silver of $76 US an ounce. However, there's different ways of calculating. There's multiple different ways of calculating it. But are you going to rely on expanded production at this mine to really make it work, Randy?
Yeah, I mean, it's one of the challenges. It's not really a challenge. It's just the approach. It's the operating approach of the consortium that runs Antamina is to reserves must have tailings capacity. It must have all the infrastructure capacity, and so the measured and indicated resources are definitely of high confidence in our eyes. The inferred resources, again, excellent continuity and great grades. It is one of the highest margin copper mines in the world, and zinc. It produces both healthy copper and zinc production, but all at a very, very low cost. And so all the exploration potential, all the inferred resources and the exploration potential, we're comfortable that this is a multi-generational asset. They've never had a problem replacing reserves. The asset's now in its 26th year of operating, or 25th year of operating, and it looks stronger than ever. The land package, that's what particularly excites me. The land package itself has even grown from when we did the original Glencore transaction. I think it's about a 20% increase in covered lands within our area of interest. And so it's a life of mine deal, which means that we'll get our share of this silver for as long as this operation runs. And that's, as I said, we look at this as a multi-generational asset.
The silver, you're bullish. I mean, obviously, you're bullish on silver. Let's have a look at silver over the past 1 year. It is off its highs. What price would you start getting concerned about this particular deal? Like silver is around 73 today. What price would you start getting? Oh gosh, would you start wondering? Gosh, should I have paid $4.3 billion US? There?
Well, again, it's multi-generational, right?
Yeah.
And so our business is to provide our shareholders access to high quality precious metals production for good long life assets, high margin assets. And this asset, first quartile, and good long life, long exploration potential and all that. So if you ask me what I think the price of silver, silver is a very volatile metal. Trust me, having been focused on silver for the first 10 years, it's got very high beta.
Yes.
And so, I don't get too concerned about the ups and downs. What I look at is the overall trend. And there's just so many factors that support that overall trend. That vector is still pointing up and stronger, and we are going to see some volatility as peace breaks out around the world, such like that. You're going to see that, but I'm just not confident in that being able to stick around long term. I'm hopeful, but not confident in that. And so I think there's two factors. One of the reasons I am bullish on silver is it's going to get pulled with gold. Gold is no doubt the main store of value, the main reserve commodity / reserve currency, and I am very bullish on gold long term. Silver gets that same benefit. It gets pulled along with gold, and so I have no doubt that there's that strength. But silver is also, I call it the most critical of minerals, because everywhere we use it in industrial applications, it makes the world better. It means we use less energy. It conducts electricity better. It has less resistivity. It means your batteries last longer. You get higher processing power. And so in this age of mobility and AI, silver is going to play an ever-increasing role to try and develop. I sit and think about where we're going with respect to AI and the processing power that's required, the demand for silver to try and give that processing power so you can have efficient AI systems in place. I don't think that's going away. Well, I just know it's going to continue growing, and so we're excited about silver, both from the industrial side and also from the precious metal store of value side. We just think it's a great place to be investing.
And Randy, just remind us, when do you step down as CEO and become chairman?
The end of March.
Okay.
March 31st is my last day as the CEO, and the team is just stepping right up. Haitham Hodley will be standing in as the new CEO. I've known Haitham for over 20 years. It took me about 5 years to convince him to come and join me here about 14 years ago, and he's been an excellent partner of mine, and I'm so excited for him and the rest of the team. So, like I said, they're sure doing a good job making my last few weeks here exciting.
Andrew was speaking with Randy Smallwood, Chief Executive Officer of Wheaton Precious Metals. Up next, the TSX Venture 50 list was released today, and more than half of the highest performing stocks belong to the same sector. Find out which one after the break. Shares of TFI International are trading lower. The trucking and logistics company saw a drop in profit and revenue in its most recent quarter, weighed down by reduced volumes and weaker market demand. The profit outlook for its current quarter also missed expectations. One bright spot, TFI raised its dividend and repurchased more than $200 million US worth of shares. Shares of Bausch & Lomb are down. That's after the eye health company reported adjusted profit in its fourth quarter. It came in below expectations. Bausch says the loss was primarily driven by an increase in income tax provisions. On the upside, revenue came in higher, driven by strong performance in its vision care and surgical segments. Revenue for this year is also expected to grow up to 7%. Japan plans to invest up to $36 billion US in American oil, gas, and critical mineral projects. This is the first set of its $550 billion US commitment under the trade agreement struck with the US. The investments include a natural gas facility in Ohio, where Japan is expected to invest up to $33 billion. The announcement comes weeks before Japan's prime minister is set to meet with U.S. President Trump in Washington. And taking a look at the markets, the tech and materials indexes, they're the ones leading the way. They are up significantly, and TSX having a nice bounce back. It's up 1.44%. South of the border, lots of green there as well. The S&P 500 up by 0.9, Dow Jones 0.59, and the Nasdaq up by 1.36. Well, the TSX Venture 50 is an annual ranking of the top performing companies on the TSX Venture Exchange. To discuss the 2026 list, we're joined by Rob Peterman, Chief Commercial Officer of the Toronto Stock Exchange and the TSX Venture Exchange. Rob, thanks very much for joining us.
Thanks, Roger.
And I believe it's 50, but I think there's 51 this year, are there not?
Yes, we can actually count, but we had a tie for the 50th spot, so there are 51 companies this year. Looking back, how did the year unfold for them? Look, it was an amazing year. You know, when you look at this list, you'll see it was very much powered by the mining sector. The 51 companies produced an average investor return of 431%, which is an amazing number. But, you know, we think the ultimate story is there's a structural gap in a number of commodities, and that gap, the new mines, are going to be discovered by the junior mining companies, and that is what's really exciting for Canada, really exciting for the TSX Venture Exchange to be leading that charge. Just going back, any concerns that I think it's like 90, I did a quick math, 95% of these companies are mining companies. Any concern that other sectors are being left behind? Well, look, you know, when we look at the venture exchange these days, it's very much driven by the innovation sector and the mining sector. This was a great year for the mining sector. I think most of us believe we're entering a new commodity supercycle. So it's not surprising that the mining companies were there. We've seen retail investors coming back to the mining sector, generalist investors coming back, and of course, you've got, you know, all these geopolitical things going on and sovereign wealth funds as well. So it's not really surprising that the mining sector dominated this year, but we know markets are cyclical, and, you know, I expect the innovation sector will show more prominently in years to come. And with the sovereign, did you see an increase this year? Is there more interest from overseas? Yeah, I think, you know, we're seeing the investors come from all around the world. Again, generalist investors coming back to the sector. Interest from retail investors. We're coming into the PDAC investor conference here in Canada. But yeah, global interest and the investments from sovereign wealth funds, international governments in the mining sector, a lot of those are into the junior companies on the TSX Venture Exchange. So it's definitely driving a lot of market attention. All right, now let's talk about some of the 50, and then we'll talk about the rest as well. What are some of the highlights from some of the 51 that are on the list this year? Yeah, so the two commodities you'll see the most of on the Venture 50 this year, very much gold and silver are the commodities that really dominated the 50 list. You'll see that what we would call tier one mining jurisdictions, Canada, USA, Mexico, were where a lot of those properties are. But if you look at the top three companies on the list, you'll see Santa Cruz Silver at number one. So obviously silver is the commodity that they're working on. Then you have a rare earth company, and the third company is a potash company. So geographical diversity and commodity diversity.
And are a lot of them North American based? Are people staying away from risk? Oh, and there's lots of risk in here, but I mean, are they staying away from geopolitical risk?
Well, the 51 companies on this list, the 48 of them are mining companies. They do very much come from what we'd call the tier one mining jurisdictions. So pretty much equally spaced between Canada, US, and Mexico. And there are some other jurisdictions on the list, but there's definitely a consolidation around the tier one mining jurisdictions. And that's a theme that we see all the time in the mining sector, is that where there's certainty and comfort with the jurisdiction, it generally makes investors more comfortable with the process of exploring and moving towards a mine.
Now, I mean, these are the top 50. There's about 1,800, I believe, companies in the venture exchange. How did it do overall for the year?
The Venture Exchange ended the year at an all-time record for corporate market capitalization. So that's a number that we look at, very positive to see that. The venture composite has had a lot of upward mobility this year, but of course, the best companies from the Venture Exchange graduate to the Toronto Stock Exchange. So it's not always perfect to look at the venture composite, but the venture composite had very strong returns. And again, we ended the year at record market capitalization for corporates on the TSXV.
Now, as you mentioned, mining dominated this year. Is there a rotation going on, like we were talking about with AI and tech stocks? We're seeing some rotation there. Is there a rotation with where people are looking for the next big thing?
Well, from our perspective, a lot of the focus is around, moving into this new commodity super cycle, the really important role that Canada is going to play in that, because we do know that most of the discoveries, the shortfalls that we see in a lot of commodities, those shortfalls will be filled by the junior mining companies and their discoveries. So this ecosystem we have in Canada, the leading global ecosystem for junior mining companies, it's a really important moment for Canada. And with all of the global attention, we think there's going to be continued momentum around the mining sector in the coming year. Okay, Rob, we have to leave it there, but thank you very much for joining us. Thanks for having me. Rob Peterman is Chief Commercial Officer of the Toronto Stock Exchange and the TSX Venture Exchange. Coming up, in January, the benchmark home price in Canada fell to its lowest level in almost 5 years. We'll take a closer look after the break. In January, the benchmark home price fell to its lowest level in almost 5 years, according to a new report from the Canadian Real Estate Association. Here to break it down is Sean Cathcart, Senior Economist at CREA. Sean, thanks very much for joining us.
Hi, Roger.
Another troubling report, I guess, is any indicators? Are we near the bottom, or is there still more room?
I think we're probably at the bottom on the sales side of things, because that was really depressed by the snowfall in Ontario. On the price side, I think we've probably got a little bit further to melt, just to continue the snow theme there. But, the lowest since spring, summer of 2021, that would have been true in every month last year as well. We've had this sort of slow melt. It really, if you look at where prices are today, was really that initial COVID increase from early 2020 to the summer of 2021. kind of made sense. We expected that anyway in those years. It just happened a lot faster during COVID. And then it took that next leg up through spring of 2022 that didn't really make a lot of sense. And that's what's been given back over the last 3 years of high interest rates and economic uncertainty of the last year. But if demand comes back, particularly from first-time buyers this year, as we expect it will, I definitely think that's going to stabilize.
Yeah, is this essentially more of almost a normalizing of the prices? After that, I mean, nothing was normal during the pandemic and what followed for that last little while. Is this almost a return to more normal prices?
It's definitely a return to, well, I mean, in terms of affordability, no. Affordability is still strained compared to what a historical average would be. But it's certainly some of the prices that were justified in late 2021 and early 2022 by the interest rates of that time period are not prices that can withstand mortgage rates of 4%. And so it takes a long time to sort of melt back down. I think we are close to sort of stabilizing. Most of that weakness now is concentrated in Ontario. And so what our forecast really is for Ontario and BC to sort of stabilize this year, whereas a lot of those hot markets that had benefited from record population growth that they no longer have, we expect those to sort of settle down. There's a bit of a convergence regionally. And we think that the story in 2026 is going to be by property type. The condo market's going to continue to struggle. It's competing with a flood of new purpose-built rental apartments and a major decline in rental demand from slower population growth. Mm-hmm. But we also have the biggest demographic group in the history of Canada, 25 to 40-year-olds, who've been locked out of the market for 4 years, who we think are going to come back. 4% mortgage rates might not be what they would like to get, but that's also at a bottom per the Bank of Canada. So I think give it a few months and you're going to start to see those 30-something show up looking to buy that first house.
And I mean, 4% is probably an average, it's probably even a little below the average over the last 40 or 50 years. We just got so used to hearing 1.9 and 2%.
Yeah, exactly. But that's where we're going to be. If you look at the Bank of Canada's policy rate, they're actually at the lower end of what they consider neutral. And so unless we are looking at a recession or some major deflationary forces or disinflationary forces, which it doesn't really look like that's going to happen, we're probably about where we're going to be. And so the last 15 years of getting a mortgage rate that starts with a 2 or a 3 are over. And the Bank of Canada has said as much, and bond markets agree. And so for any buyers that have been waiting, saying like, I'm not going to lock in a 5-year rate until it's at the bottom, that's now.
All right, we didn't really get into the numbers off the top. Let's talk a little bit about which markets took the biggest hit and which ones do you think are ready to rebound there? I mean, because we do have some interesting factors because we have that almost negative population growth or zero population growth or minimal playing in with the fact people do eventually have to move. Which areas took the biggest hit and where do you see the rebound coming?
Well, in January, it was definitely southwestern Ontario and the greater Golden Horseshoe because people were under 2 feet of snow. So January is one of those months that's more noise than signal. And because that's a logistical reason for the drop in demand, not a fundamental one, it's the old toothpaste tube, right? What gets squeezed out of January is likely to show up later. Mm-hmm. So I think that we're going to continue to see the biggest rebound in activity and people coming back into the market this year in Ontario. That was the case through the entire second half of last year. Of course, the reason for that is that Ontario has the most room to rebound. In other words, they were starting from the lowest starting point. And that's going to be followed by BC. BC obviously hasn't been as depressed as Ontario because Vancouver really hasn't been all that much impacted by high interest rates because properties there, especially ground-oriented ones, are not the kind of thing that people take out mortgages to buy. This is, you sort of have to have $5 million, right? And then everywhere else, these hot markets, Alberta's already slowed way down. Saskatchewan's slowing down, Manitoba, Quebec's still on fire, and the East Coast is still doing pretty well, but all of them are slowing down. So from 6, 7, 8% year-over-year price growth last year, we're expecting for those guys to be more like 3, 4, 5% this year. So that's a major slowdown, still moving in the upward direction because there still is a lot of demand for housing in places where you can get a detached house that's in the $300,000 and $400,000 range.
Now, are we seeing pressure on some of those areas that maybe people went to during the pandemic, the work from home and all that, now we're getting this pressure for everybody to come back to work. Are we seeing people having to move distances because they thought they were going to stay work from home forever?
There might be some of that. It's initially in COVID, it was, I don't have to commute anymore, so I'm going to move somewhere. And then as people started to call back to the office, you had a second wave of people leaving who are more like in the sort of late 50s, early 60s range, who said, I'm not going to commute back into downtown Toronto. And they're living out in Nova Scotia now. And then you've got another wave of young people who continue to move out in search of a family-sized home that they can buy and own on the ground, which is not possible for a lot of people, maybe a majority of young people in and around the Lower Mainland and GTA, because housing is just too expensive unless you've got a gift from the bank of mom and dad, which is becoming increasingly common. People are, it's a trend we've been watching for 15 years. It used to be from Toronto to Guelph, and then it was Toronto to London, and then it was Toronto to Calgary, and maybe today it's Toronto to Regina. But people are moving around, and that's driving up prices in those other places, so that we're sort of getting an equalization where we're not going to have very many CMAs left where you can get a regular family home for under $500,000. Okay. But we're still in the midst of that same trend.
All right,
today.
We have to. Sorry, Sean, didn't mean to cut you off. We have to wrap things up there, but thanks very much for joining us.
Anytime.
Sean Cathcart is a senior economist at CREA. Coming up, we'll check in on the markets on Bay and Wall Street. Market turmoil unleashed by AI advances points up two seemingly contradictory fears about the tech, that it won't fulfill its very expensive promise and that it will swallow up vulnerable industries. Bloomberg Originals has more.
Wall Street is suddenly waking up to the fact that AI might impact a larger number of industries and faster than they had expected.
What this story is about is how AI disruption fear is leading to sell-offs in parts of the market outside technology. On Wall Street, rising fears about artificial intelligence, and specifically where it will disrupt certain companies, are sending shares of those companies tumbling.
Wall Street has done an about-face. Investors were concerned that AI was costing too much and might lead to a big bubble with untold harms. Now investors are concerned that AI is going to be so disruptive that it renders countless businesses obsolete. There's definitely been a spillover, starting with concerns about legal services, SaaS companies heading into insurance firms, tax preparation services, financial services, each of these in reaction to incremental AI products. The market sell-off really started in early February when Anthropic introduced a plugin to an existing product, one that they did not even really do a formal announcement for.
So what we saw on February 10th, for example, was shares of wealth management companies sell off after Altruist, which is a little-known AI startup, came out with a new tax strategy tool. Look at the stock slides of companies like Salesforce, Charles Schwab, and Blue Owl. Investors are concerned that AI might be able to replicate their offerings soon. The fear for investors right now is that they're going to get caught up in the next version of this sell-off, and so they're really looking for ways to avoid that.
Let's take a step back. In November of 2022, OpenAI kicked off the AI boom. When ChatGPT launched, people were mainly using it to spit out clever song lyrics and poems and pithy responses to things. But what we've seen in the last year or so is that people have been using these to shop for products online, do more advanced online research, and even build apps from scratch with little expertise. Wall Street now seems to be waking up to the fact that those same tools can be used across different sectors.
These tools are coming out and they're good. And so what we're seeing is investors really worried about the parts of the market that are tied to AI risk and looking instead to go more into the AI winners. This chart depicts two baskets of US listed stocks from UBS research analysts. One is AI winners and one is AI risks. So you can see there's been a massive divergence as investors look to avoid companies associated with these risks and flock towards the AI winners.
that technology has been very disruptive in a certain corner of the world, particularly Silicon Valley. But in recent months, it feels like there's been a mainstreaming of it, where we're seeing broader awareness, right? You can use that same technology in your everyday life or in other sectors, even if you don't really want to code.
We've seen video game stocks get hit after a new Google Gemini launch. We saw insurers get hit after a startup came out with a new product. And even more recently, real estate stocks are selling off as investors think that this could be the next place that's going to get hit.
At the moment, Wall Street seems to be whipsawing between two different, extremely opposing views. There are investors who are concerned that tech companies are spending too much money to build AI services with an uncertain payoff. On the other side, investors are anxious that AI will be so disruptive that it renders numerous businesses obsolete.
I've definitely heard sources say that they just don't understand how both of these things can be true at once. They don't think that these knee-jerk reactions would be happening if we weren't near record highs on the S&P. We don't know what next feature or new product is going to be released that sets off the next sell-off, so really we're just watching to see what happens next.
Unsurprisingly, it's hard to predict where things go from here. What's clear is that the large AI developers and a long list of AI startups plan to bring advances to more and more sectors as they try to make money from this technology. So we should expect that if Wall Street is now worried about how disruptive AI could be, there will be plenty more moments in the months ahead for them to be concerned.
Market Call is coming up next. Today on the show, we have Michael Hakes. He is the Senior Portfolio Manager at the Murray Wealth Group. He'll take your questions on U.S. and global stocks. Thanks for watching Morning Markets. We'll see you back here tomorrow.